Hello, everybody, and welcome to Confident Compounding with Corey Kramer. I just wanted to make a quick video where I talk about Jerome Powell's speech at Jackson Hole, the Fed, and interest rates and inflation. So this is mostly going to be a reiteration of what I've thought for quite a while now, and I do have a video or two out on it, but it's been a while since I've commented on the Fed and kind of what's happening. So my position for a long time has been that the Fed is not targeting 2% interest rates. It was interesting in the speech that Powell said they decided to stick with the 2% inflation goal because they want to keep inflation expectations anchored, and other countries have a 2% inflation goal, which I thought his wording was interesting there, because he didn't say that he wants inflation at 2%. He said, we want people to think inflation will be 2%. And it can be easy to overlook that if you just are listening to, what he's saying. Just for the record, I like Jerome Powell. He seems like a decent man. I think he's done a good job at the Fed. So this isn't going to be like Fed bashing, but it's important for investors to understand that this 2% goal is fake, basically. They don't want the 2% inflation, apparently. Well, maybe they want it, but they're not willing to risk a recession or higher unemployment to get that goal. So to make my case here, I went back to when Jerome Powell became the Fed chair at the beginning of 2018. So regular inflation, CPI, is up 30%, so 3.5% per year, and core is run 3% per year. So, I wish a reporter or somebody would ask him, and this is a hard question. Like I said, I like Jerome Powell, but if I was one of these after the next Fed meeting, I would say, do you think your time at the Federal Reserve has been a success, given that your target was 2% and inflation is running 3 to 3.5% over not a short period of time, but over 8 years, right? And it's still not 2%, right? Now, before I would talk about this, I would say, well, the Fed says they want to get inflation back down to 2%. But if you get it down to 2% after it's been like 5%, that's not 2% inflation. That's 3.5% inflation, right? They would have to go below 2% for a while in order to make up for the time where we had. Now, most of this is because of stimulus money for the pandemic, and that's another story. That's another inconsistency, I think, from Powell in this situation, because he'll say how bad inflation is because people that don't have as much money or have lower wages can't afford to pay for the inflation. But he also he defines inflation by wage growth, right? So if inflation comes from tariffs, well, that's okay. If inflation comes from taxes, well, that's okay. If inflation comes from anything but wages, it appears to be okay, or maybe they can't do anything about it. But the very thing that would allow people to pay for the inflation, which the stimulus money actually did during the pandemic. I didn't graph the wage growth on here, but it's more than inflation, even during his pretty much every year that he's been Fed chair. Even during the pandemic, when inflation was high, wages were higher. So people can't afford to pay for the inflation, right? So that just doesn't make any sense. It doesn't make any sense at all. He did a good job from a rhetorical standpoint of trying to balance all these things out in his speech, which was in well-crafted speech, I think. But for investors, you have to kind of cut through some of this and get to so what does this mean for investors, right? I think it means that, well, I've said, especially very recently, Trump is going to get lower interest rates no matter what. If he has to appoint himself Fed chair, he's going to lower short-term interest rates. So over the next year or so. So we know that's basically happening. we know, unemployment's only at 4.2% or something like that. The real problem isn't the unemployment rate. It's that people aren't making enough certain lower income people aren't making enough money to pay for the types of inflation that we've had more recently, especially when you consider the amount of it. I don't even know if inflation is the problem. It's that the debt that most people have is a problem. So that becomes a problem for banks, the Fed, if people can't make their loan payments, which is what the Fed really cares about. It's what bankers really care about. So if you lower interest rates, that's kind of in your own self-interest to make sure people can keep paying their loans, even if maybe they need to refinance them or whatever. You don't want defaults is what you don't want. So there's a lot of different kind of cross currents that are happening here. But short-term rates are going to come down because that's what Trump wants. And the question is, what happens to long-term rates? What happens to like 10-year yields? Do they come down? They didn't last time the Fed cut. And it could go either way, but I don't think that they're going to come down without QE again, without quantitative easing, without the Fed buying. So like come down significantly. There'll be these like fluctuations, but not like really low where mortgage rates are going to fall enough to like really boost the housing economy and auto purchases, RVs, that type of thing. So, but the short-term rates might come down. So then the question is, how do we get this QE? Well, if it happens, which would be the only way I think 10-year yields go down considerably and stay down long enough to like really positively affect the economy, it'll have to be probably with a new Fed chair. I don't think Powell is going to do that. And probably they'll just lower short-term rates as the first step. And then eventually they'll get, if they decide, if long-term rates might come down. I mean, people have no other place to put their money. People will be trading the bonds as well, expecting them to come down. So, I mean, so we'll see what happens there. But the main thing for investors is, which I've said for years and years, just don't buy long-term bonds. Don't. They are the sucker bet. That is the sucker bet. And the whole goal of Besant and all these people is to try to get people to buy them, which is good for America, good for Americans, because if people loan you money at a rate lower than inflation, then you pay them back with money that is devalued. So you're actually getting free money or maybe even gain a little bit, especially if you can invest it. But you don't want to be one of the suckers that's buying the long-term debt, right? So that's the main thing. So what are the positive takeaways? I think the positive things you could potentially do as an investor. We are also probably looking at a weaker dollar if they do all this, and they're able to get lower interest rates. Maybe they do it QE. Maybe they find some other inventive way to do it. I don't think they can hold up the U.S. dollar. So high quality stocks, international, preferably that if they don't trade it with the U.S. I mean, if you can find them, or have very little exposure to the U.S. and that type of tariffs and things like that. That's where I think the best opportunities over the next probably 5 years are. And you just have to find them at good prices, and you have to make sure they're high quality, which is hard. It's hard to do. That's the challenging part. But you'll have a tailwind, I think, if you're aiming for those businesses rather than bonds, right? Bonds are considered safe. They're not safe if you're guaranteed to lose your money almost, like lose a little bit. You're not going to lose a lot. It's like skimming the penny. It's like the Superman 3 or 4 or whatever which one it was, where they skim a little bit of money off of, or Office Space where they talk about it, right? You want to slowly erode people's purchasing power that have lent the U.S. government money. And that's what they're kind of doing now with telling everybody inflation, they're targeting 2% when it's really 3 or 3.5%. It's not big, right? And it's 1% a year, but if you compound it over 10 years, it adds up, right? Especially when you consider the opportunity cost of losing a little bit of purchasing power, which is compared to compounding, let's say, even 2% a year compared going up, right? Compared to 1% losing it over 10 years. The differences are astronomical over time. But the idea is to kind of imperceptibly get people to do it. So I guess my only big thing is don't buy long-term bonds. I do like stocks outside of the U.S., growth stocks especially, ex-China, ex-Russia, avoid those. Try to find the ones that nobody are paying attention to, if you can. And that's what I've been, I lean more heavily toward those lately. But just also high-quality small businesses, niche businesses in the U.S. or Canada or in Europe, anywhere, that aren't doing a ton of external trade, that are small, that have little businesses nobody cares about. They're hard to find too, but lean more into those. Those have done really well the past couple of years, and I expect if there isn't a horrible recession or something like that, that they'll continue to do so. And if we can keep just putting cheap money out there, there might not be a recession. This stuff works kind of until it doesn't work or something breaks or whatever. So stay well balanced. I still have plenty of cash, but I'm always looking to invest it in short term. That's going to lose some value probably over this year if inflation stays high and those interest rates do come down. Probably have one more year and 6 months at least until we start to kind of really feel that. So I don't think there's a big rush. There's enough crazy stuff happening in the world that the stock market could fall enough to find, like we saw in April, where you can find some good deals. So there's a lot of things going on, but if you kind of get the big things not wrong, then that can definitely help over the long term. So those are my thoughts on Powell, inflation, the Fed, and the dollar and all that stuff. Thanks for watching. If you found this useful, hit the like and subscribe button. I usually do individual stock analysis. Every now and then I interject with a video like this, where I think there's kind of an important big picture that kind of the stocks fall in the context of. So I'll see everybody later.